Let's talk about a surprising but incredibly important economic indicator, the weather. In our previous videos, we've gone through all kinds of economic data that gives us a gauge of how the economy is performing and what future trends we might see. Things like inflation data, economic growth, manufacturing data, consumer and business confidence. But as silly as it sounds, the weather is also a very important one for many reasons. In fact, a lot of the data we see will be higher or lower due to the weather conditions during that time. For example, you'll often see GDP data coming in positive or negative, with the caveat being that it was partly due to good or bad weather. It just happened recently in the UK at the time of filming this. Negative economic growth in July, partly due to bad weather. Now, since weather has such a big impact on the economy, it's also going to affect the financial markets, especially certain commodity markets, since the weather will impact production and demand. And actually, weather also affects market participants. There are many studies showing how good or bad weather conditions affects things like the level of risk-taking from traders and investors, or the spreads provided by brokers. But we won't go into that for now. Instead, let's focus on weather as an economic indicator. We'll start with one of the more obvious ways that weather has an impact, which is on the production of agricultural commodities. Weather data can be a leading indicator of things like crop yields and crop quality, as agriculture is one of the most weather-sensitive industries. When there are extreme weather events like droughts, floods, or extreme hot or cold temperatures, this can negatively impact crop yields by reducing the amount of water available to the crops. It can also damage the crops directly or cause things like soil erosion. This can lead to a shortage of the affected commodity, which can then drive up its price because supply reduces without a similar impact happening to demand. On the other hand, when weather conditions are favourable, like when there's enough rain to nourish the crops and temperatures are not too extreme, crops can thrive and yields can be higher. This can lead to an excess of the commodity, which can put downward pressure on the price as supply outstrips demand. Then we also need to consider the timing of the weather event. So different crops will have different growth stages that are more or less sensitive to extreme weather. For example, a drought that occurs during the flowering stage of a crop may have a more severe impact on its yield compared to a drought that occurs at a different time. Or another example is if there's a frost that happens at the wrong time. This can damage crops and impact their quality, but some crops are going to be more frost tolerant than others, and whether or not a frost will damage a crop will depend on the stage of growth that the crop is in and the severity of the frost. So weather can greatly affect the production and yield of commodities like wheat, corn, coffee and soybeans. It's not just agricultural commodities that are affected. Other commodities can also be directly affected by weather as well. For example, energy is really sensitive to it. On the demand side, weather can determine how much oil and gas is used for things like heating. So typically, a colder winter will create more demand. And this is a dynamic we saw fairly recently following Russia's invasion of Ukraine, because in the summer of 22, there was a lot of concern that Europe wouldn't have enough stocks for a cold winter. This helped push gas prices up to record highs. But then fortunately, Europe ended up having a milder winter, which helped get gas prices back down to pre-war levels in January. Then on the supply side, severe weather can damage energy infrastructure, such as refineries or pipelines. There are many oil refineries located in the south of the US, and it's not that uncommon for them to be damaged by severe weather in recent years, which therefore reduces refinery capacity. There are also lots of other commodities that can be disrupted by weather in ways that might not seem so obvious. Like mining, for example, poor weather conditions can reduce mining capacity, or strong storms at sea could disrupt transportation of minerals and other things. So ultimately, if the weather disrupts the supply of commodities and it leads to commodity prices increasing, that could be passed down through the production chain to the end consumer, and this may then show in inflation data. Now, energy is quite an important one to follow in this respect, as almost everything that we buy has an energy input cost. So if energy prices are increasing, that can quickly filter through the economy, creating inflationary pressures. Changes in the weather can also affect transportation, just like what I briefly mentioned a moment ago about how stormy seas may disrupt cargo shipping. But we can also look at the transportation sector more broadly. For example, if there's heavy snowfall in winter, that could cause delays or cancellations of flights, leading to losses for airlines and other transportation companies. And if it's severe enough, it may create a significant enough impact in their earnings reports, and their stock prices may fluctuate as a result. Now, some countries are less prepared than others for any extreme weather that they get. For example, the UK seems to struggle with any major weather changes. In the winter, we're basically shut down with the lightest bit of snow, and in the summer, our airport runways are melting. And regardless of what weather you get here, you can always guarantee one thing: people will be moaning about it to each other. But in terms of the economy, this can cause disruption to travel networks like roads and rail, which can have a significant impact on economic growth. So we'll see this appear in GDP data. Finally, the weather can also have an impact on consumer spending. For example, extreme weather events such as heat waves or cold snaps can lead to higher demand for air conditioning or heating systems, as well as different types of clothing or equipment. So this would lead to higher or lower sales than normal for particular companies producing those goods. Weather also affects consumer sentiment. People are more likely to go out and spend more money when there's good weather, and particularly when there's unexpectedly good weather, when people want to take more advantage of it. Whereas if the weather's miserable, people are more likely to stay at home and will be spending less money. However, even in that situation, there will be companies that benefit, like delivery companies. So this is just an overview of some of the key areas to get you thinking about how weather affects things when you're doing your fundamental analysis. In reality, we could go on for hours detailing the specific ways that weather affects different aspects of the economy or specific markets. If you ever talk to a farmer about how it affects their, whatever they're growing, you'll realize there's a lot of detail to it. But for now, it's just something you need to pay more attention to. And if you want to understand economic data and try to figure out how weather might affect all of those different data points, check out the playlist that's on screen where we go through all of the economic data that you see in the monthly cycle which impacts the markets. Thanks for watching.